Hello, this is Mike Swanson. I run the website WallStreetWindow.com. The odds are that you're watching this video because you found out about it from an email I sent out to my email list. Now, if you're not on my email list, you got to get on it so you can get all my morning updates before the market opens. Because we're in an interesting time, but what we're going to do today is the third video in my series of videos called Stock Trading 101. And much of it's based on my book, Strategic Stock Trading. It's a classic book. You can find it on Amazon.com. It's been out for like 10 years. That's why I call it a classic book. You can see all the reviews for yourself. But we're going to build off of what we talked about in the last video, where I said there are three basic trends in any market that you got to know about. And they were simple: uptrends, that's when something's making higher highs, higher lows; downtrends, lower lows, lower highs, or sideways. And it's easy to look at these three trends on a short-term chart, 60-minute chart, or a daily chart, and try to come up with some trading method based on when these patterns change. In fact, that's how I start out in the markets as a day trader, essentially using these simple patterns. When something stopped going sideways and started to go up and make higher highs and higher lows, that was my buy signal. But we can apply those trends in an even different way, in some ways a critically important way, and that is looking at where we are in the big cycle of a market. And I'm talking about cyclical bull and bear markets that typically last 3 to 5 years, because it's critically important to know where you are in that cycle in order to know what are the best tactics to trade and use depending on where you are in the cycle. You don't want to do the same thing in a bear market that you're doing in a bull market, obviously. So let's just step back. We'll apply this concept to a few markets today. That'll give us an idea of how we would trade this or that differently. What's the optimal way to do it? So the first thing I do is I've got to share my screen, and you're going to look at my website for a second here. This is an article I wrote several years ago, 5 years ago, actually. But just want to show you an image on it. This is stage analysis. That's the cycle of the market. Stage 2 is a bull market. Stage 3 is a topping phase where you're going sideways but making a top. Stage 4 is a bear market, lower lows, lower highs consistently until that ends, and then you get into the stage 1 bottoming basing phase, characterized by sideways price action, which finally ends with a new bull market. But you can easily identify where you are in a market cycle by the long-term 150 and 200-day moving averages, because they tend to act as price support in a bull market and resistance in a bear market. And when you're towards the end of a stage 3 top, they start to curl down to give a serious warning sign. And when you're starting to begin a new bull market, they had been flattening out for a period of time and start to curl up. An incredible signal. So here's the thing. You could think about how you could navigate each of these situations differently, but I'll just tell you real quickly, when you're early in a bull market, and I'm speaking just, maybe even the first year of a bull market, the best way to make money is to invest. It's to buy things with the intention of holding for several years. And when you're deep in a bull market, or even at the stage 3 top, and it's the stage 3 top is probably the most difficult time in the market. It's one of the trickiest times, because when you get to the top, everyone's bullish and thinks things are going to go up forever, but the market actually starts to get more volatile. That's one characteristic of a top being put in, but it doesn't mean you can no longer make money. In fact, at a stage 3 top, a lot of money can be made in speculative short-term type trading, because whereas at the beginning of a bull market, the best thing to do would be take long-term investment positions. at the end, what tends to happen is the good companies that have gone up for years kind of no longer exciting people. They're not going up as much. And you start to get very short-term momentum style plays that start to appear. So when I got into the markets in the late 90s, that's what was happening with internet stocks. And what happens with short-term extremely speculative plays is a lot of them end up going up and then straight down. So it prioritizes, it makes the short-term trader a winner at the time, because these short-term things tend to make big gains, but if you get out, then you can lock them in. So it's a different style of trader that starts to rise up in the markets and become the winner for the time being. And this, as I'm doing this video in early 2021, sort of the same thing has happened. We've seen the rise of the crypto player who gets into coins and has the coins shoot up, but he's got to get out before the coins drop. Same thing with, there's been a series of short squeeze plays that have got the attention of the media. A stock called GameStop went from like $10 to 400 and then crashed. Again, this is the rise of the short-term speculator who's winning at the moment. The problem is, once the stage 3 top tips over into a new bear market, or begins to, all these speculative plays blow up. And most of these people that get caught up playing these things have really, they end up, a lot of them are new to the market. They don't really understand what's going on. They think this is normal and it isn't. Then they wipe out. So as I do this, I think this sort of thing is what is starting to happen. But, you know, I saw it happen in the 90s, in 1999 and 2000. It happened with real estate in 2007. It's happened with commodities and so forth. This is just the way markets work. But where you are in the cycle determines on what tactics are the most successful. And in stage 3 tops, or the very last inning of a bull market, it is the speculative short-term traders who are the most successful for the hour. And at the beginning of a bull market, you want to be in long-term investing. In bear markets, you want to be very, very cautious on everything that you're doing, because they're, you know, lower lows are, and it can consistently is very difficult. So the good news is that there's many markets you can trade. You don't have just stocks, you got commodities, you got bonds. You don't just have the US stock market, you got sectors inside the US stock market. You got foreign markets all over the world. So you can find a market basically just about in any given year somewhere that's early in a bull market. And as I've gotten older, I like to be one of these long-term investors. So last year we actually saw many new bull markets begin, some in foreign markets, but we saw that happen in commodities. So this is the CRB index. It's a broad-based commodity index, and it made a massive low last year in the spring of 2020, and has doubled since then. But if you can see on this chart, the green line is the 200-day moving average, and it's now curling up. So we're in the first, not in the 10 months or 9 months of a new bull market here. It's gone up enough that we're probably at a point where it's likely to pause, digest some of these gains, but it's still early in the first year. So this is still a place and a huge element of all the financial markets where long-term investment positions can be taken as we go forward in 2021. So that's, to me, the most exciting spot for putting new investment money to work this year. We also saw a massive cyclical bottom in long-term treasury bond yields last year, which the bond market trades opposite to treasury bond yields. So this represents a top for many bonds in the corporate bond, and particularly the corporate bond market, with many ramifications. So as we saw a bottom in commodities, we saw a bottom in interest rates with big ramifications for bond investment funds. Now let's return to the stock market. And it's we've had this massive run in the stock market for years. We did have the drop in the spring of 2020 because of the global sickness situation, but we bounced back hard. But we've seen rampant speculation in the last 6 months. That is one of the characteristics of a tricky stage 3 top. And that has also brought us, once again, as I said earlier, the rise of the speculator as the winner for the hour in the markets. But when you look closely at the moving averages, you can start to see that they're starting, the momentum in the moving averages is starting to flatten out. It looks like where you could be seeing a stage 3 topping process. So there's been several over time. So it's a very, very tricky market at this moment. And one sign of that too is that many of the big winners of the past several years, the Amazon stock, the Facebook stock, these big cap tech stocks that have been the big market winners, the best stocks for people to really buy and hold, they're not working as well anymore. They're actually underperforming the market. And Amazon, for example, closed last week. I'm making this video on a Sunday. It closed on a Friday below the turn-day moving average. Again, this is the type of thing that you do see at stage 3 tops in a market. Now, when I say that, I'm not saying the stock market's going to fall for 2 years or 3 years or something like that. I don't really think that's what's going to happen, but we could very easily see, as I'm making this video, a correction in the market. But what's more important is to think about what's the best tactic to use to invest or trade in a market according to where that market is in the cycle. And there's signs that the stock market's in a stage 3 top. That means that short-term day trading in the S&P 500, in the typical NASDAQ stocks, is actually the winning thing to do. But at some point, it could easily start to blow up because that's what happens when those people start to be the winners in the market. And if you want to be the long-term investor, it's outside the S&P, it's outside that where really the best opportunities are. And I'm pointing out commodities. And the best way to invest is do so on dips, that take place and hit the 50-day moving average, or if you're lucky, the 150-day and 200-day moving average. Now, with commodities, you also have many, many sectors that are related to commodities, energy stocks being probably the biggest. So you can buy them, I would say, on dips to the 200-day moving average. And I do own some as I'm doing this video. So this is, again, working off the last video. And each video I'm seeing as a building block in this series. And again, grab my book. It's available on Amazon, Strategic Stock Trading. And if you're new to me on YouTube, click the subscribe button on this YouTube video and click the bell next to it. Then YouTube will send you a notification as soon as my next video is uploaded in this series. And I also do videos about what's going on in the market, or talking about individual stocks and interviewing other top traders. And subscribe to my email list if you're not on it too. There's a link in the description of the video to do just that. And I'll be talking with you later.